Now, C. Kumar asks, how is return from debt funds related to interest rate?
The linkage of interest rates to debt fund is actually on two fronts, and investors should understand, very intimately how it works. When a bond fund is nothing but it's holding a certain, a bunch of bonds, and if when interest rates go down, the fund will continue to get higher returns, higher interest on the prevailing bonds that it holds. So that is why when interest rates go up, the return from new bonds that will be issued or which a fund will invest will be higher. That is why the bond prices or the price of those bonds held by the existing bond fund, they go down in value. The opposite happens when interest rates go up, when it goes down, because when interest rates go down, the fund manager is holding a bunch of bonds which will yield, say, 10%, and if it has come down to 9%, the bond prices will, which the fund manager or which your fund owns, they will go up in value because they will continue to benefit from higher interest rates till the expiry of those bonds which is held by them. So there is an inverse relationship. A bond and those bonds which have longer maturity, they tend to benefit benefit more when interest rates go down. So the bond fund which have longer maturity, they are also hurt more when interest rates go up. And when so this is a one-time event. As and when interest rate change or the outlook for interest rate changes, there is an impact on the bond fund. There is another thing which happens. If interest rates go up or go down, then the current yield on the existing bonds will also change. So bond funds actually get two things. One is that appreciation or depreciation on the bond that they hold, and the interest repayment, the not interest repayment, but interest payment that accrues on that bonds, whether it be annually, semi-annually, quarterly, whatever be the depending on the term. So that interest rate which a bond receives, which a bond fund manager or a bond fund owns, that can come down or go up depending on the prevailing interest rates. So these are the two kind of things. So by and large, there's a one-time impact, and then there is a continuing running impact depending on the interest rate.